Good morning, hello and welcome to Opening Bell. I'm Surabhi Upadhyay. It's the morning after, it's the day after. Budget 2026 is done. Was the market's disappointment captured just yesterday in that Sunday afternoon alone? Or is there more to go? That is the critical question as we kickstart trade. We're just about a minute away from market open. Global cues have been very, very tentative. It's a risk off across global equities, not just equities. We've seen that play out on gold and silver with the mega crash on Friday. There is some rebound in gold and silver prices this morning. However, it hasn't proven to be durable, at least on gold. Silver was up about 4% last I checked. Crude oil prices have been in the grip of this global risk-off as well. Brent oil prices have declined from a high of about $71 on Thursday to about $67 this morning. So that's one positive cue. But US futures are telling us that it's going to be a cautious start once again on Wall Street. So that is the big global backdrop against which we gear up for trade. And first rates will start coming in the next couple of seconds. Of course, we have our panel of market experts, tax experts, and of course, technical experts to take you through today's trading action and to make sense of really what lies ahead for this market once the budget is done and dusted. So that's what we have, and I'll quickly take the first rates and then introduce our market maker of the day. We've got a 50-point downward drift on the Nifty. So the decline and the disappointment that we saw yesterday, it continues at the open. The index right now is down about 50 odd points. Let's refresh those rates so we get the latest ones on the screen as well. The mid-cap index is also opened with a cautious start. 0.25% lower on the mid-cap index, 0.25% lower on the Nifty. The Bank Nifty this morning, this Tuesday morning, is down about 0.5% again after yesterday's slam dunk. So that's the big problem. Let's change those rates and get to the Bank Nifty. That's the Nifty at this point in time, about 60 odd points lower. The Nifty Bank will come up on your screen. It's down about 0.25%. So stabilizing, but the bias is very clearly negative. The advanced decline ratio, at least as of now, as of the opening tick, is favoring the decline. So let me quickly, run through where the pain points in the market continue to be. So you've got some of these financial names like Shriram Finance. They've started off on a down note. ITC is cooling off a little bit. Bajaj Auto, Bajaj Finserv. These are some of the other Nifty losers. Let's pull up some of the other Nifty losers on the screen as well. Titan, for instance, is down about 1%. Cipla, Trent. So, this is pretty much bringing up the list of the negatives. The Bank Nifty is recovered from that first opening downtick because remember, these big bank stocks, they fell off the cliff anyway yesterday reacting to the budget announcements. So this morning, there's some effort to make a comeback. For instance, ICICI Bank is in the green. You have Axis Bank, which is sitting exactly at the flat line. Let me check what State Bank of India is doing because SBI, remember, I tumbled about 5% yesterday. It's opened on a flat note. So the market now is stabilizing. You can see the first green tick on the Sensex as well. The mid-cap index is still reeling under pressure. Let me quickly check two other category of stocks which were really pummeled yesterday, and those would be the defense names and the capital market names before we continue. There's a bit of a pullback on the defense names. I can see Cochin Shipyard, Paras Defense, BEL, Masgaon Dock. So some of these defense names are actually now a little buoyant. They're flashing a little bit of green. There we go, first ticks coming through. But on the capital market side, the brokers, that STT hit that we've been discussing since yesterday, that is still pinching because you've still got a shade of red on the likes of Billion Brains, Grow, IIFL, Angel One, Motilal Oswal. So all of the broker stocks have again started this Monday morning on a bit of a somber note. So that is the market, and that is the backdrop against which we're looking at this Monday. Let me introduce my first guest on the show. Vikas Khemani of Carnelian Capital joins in. He's our market maker of the day. Vikas, good morning. Thank you so much for being with us. Vikas, I'm not sure if you can hear me.
I can hear you.
Yeah, okay. Okay, all right. I can hear you as well. Because what a budget, what a Monday. Doesn't feel like a Monday because we've had this whole working, I think for many of us, in the media industry at least, was a working weekend. But really, I mean, it's the morning after. Do you think the worst was over yesterday? The worst of the pain is out or not yet?
I think, we have seen the context. 1% market movement, 1.5% market movement is a, normal movement after any kind of event. And yesterday, in some sense, You did not have all the participants active also in the market. So I would say that, yes, event is behind. The budget needs to be seen in the overall context. I don't think there's as much disappointing as it is being made out to be. It is continuation of all the policies which government has been saying, a little bit more focused on that. I mean, if you just take out the big narrative about the STT, let's say, I mean, there's nothing negative in the budget per se. They've tried to address every aspect of the economy, boosting manufacturing, boosting services. The capex expanding has gone up, defense spending has gone up. The fiscal fiscal targets have been kind of, or discipline has been maintained. So I'm saying, if you just broadly just see directionally, there's nothing wrong with the budget, except if you take the STT part out, which I also agree was unwarranted or uncalled for. So I guess market will get over it, and I think we will go back to the normal situation of how the global markets are, how the corporate profits are, and how other economic factors at this point in time which are playing havoc globally. So we are in a globally uncertain environment. Every day we see kind of a lot of news flow which is creating uncertainty, and we have to see in the context of that. There are good positive developments, there are not so positive developments. Now, all those things have impact on the markets. Budget is just one more of that event. And I don't think incrementally, if you see over the last 4, 5, 6 years, the budget of importance of the budget has gone down because most of the policy announcement happens outside the budget. Budget is just only very few policy announcements. So I think broadly we are back to normal, and the current market sentiment is of course not so positive given the global sort of uncertainty, and we are back to that reality.
Lots to discuss, Vikas. I want to go over each of those heads in some more detail with you, talk about capex, defense, consumption. Just allow us 2-3 minutes since the market is open. I'll quickly, take the trades of the day with our technical expert, and then we'll come back to this conversation. We need to give it some time. So just give me 2 minutes there. I think we now have Nilesh also with us, Nilesh Jain of Centrum Broking. Nilesh, morning. Now, pure technicals. A lot of levels have just come and gone in this market. Where are we? Let's talk Nifty first. Do you see supports in sight? Do you see a long trade at all? Or is the structure too weak for a long trade as of now?
Very good morning, here, Sulpi. Well, absolutely. Yesterday, we have seen a breakdown where Nifty broke below its long-term 200-day moving average, and also it has ended below its psychological support of 25,000. So on derivative front, if you see, we have seen the call writers have got active at 25,000 strikes. So that is kind of a strong barrier as of now for the Nifty. Good part is that we have recovered yesterday from the lows near about 24,571, and today as well we are witnessing a good rebound on the back of a buying interest in the heavyweight counters, and also we are getting support from the banking space as well. So overall, with the RSI reaching in the oversold territory at 30, I believe there could be possibility of a strong pullback move. We are expecting a pullback move towards 24,950 to 25,000 from current levels. So there is a trade on the long side at current level, but this should be treated merely as a pullback trade. We are not expecting any V-shaped kind of recovery. We may see selling pressure coming in again near about its 200-day moving average. So focus should be on stock-specific move.
What about the Nifty bank?
What
are the next sort of support levels? What levels to watch? I mean, is the poison out or is there more?
Well, comparatively, Surabhi, the structure of the bank Nifty looks better placed. Even if you see on yesterday's trade, it has defended its 100-day moving average. It is trading well above its long-term 200-day moving average as well. So comparatively, the structure of the bank Nifty looks better compared to the Nifty index. It has found a very strong support at 57,800. So that should be the stop loss for the long position, and we are expecting a pullback move towards 58,800 to 59,000 on the upside. So yes, the structure of the bank Nifty looks better. The focus should be on the banking space.
Okay. All right. You said it's better to be in individual stocks. So Nilesh, run us through what are your trades for today?
Right. So as mentioned, we are positive on the banking space. First of all, ICICI Bank at current level looks promising after a sharp decline we have seen in last couple of trading sessions. So keeping a stop loss below 1325, one can go long in ICICI Bank for a pullback move towards 1360 and 1375. So these are the two targets on the upside. And another stock that's again on a positive side is GE Shipping. So GE Shipping, after yesterday's fall, today once again it has regained the momentum. So we may see a follow-up on the upside towards 1250 to 1270. So one can keep a stop loss below 1195 and go long on GE Shipping as well.
Okay. All right, Nilesh, thank you very much for joining us and wish you a good trading day ahead. Thank you.
Thank you, Survi.
Okay, let's get back to our conversation with Vikas. Vikas, thanks for that. So the trades are out of the day. Now the question is really portfolios and investments, right? And there I just want to start from the basics. Let's get back to the drawing board because a lot of people have been just wondering. And let's look at capex and defense. I mean, those were the only two real expectations with which the market went in. Now, defense spending is actually up about 15%. I mean, over 7 lakh crores is being allocated to defense. But I think there's some confusion on whether this really is a big enough opportunity this year for private players, because I think the amount in terms of acquisition from domestic players, that is perhaps a little lower than the market's estimates. What did you make of the defense numbers and the way the defense pack sold off yesterday? It's this is an area which I think in the past you've looked at favorably.
So let's see, one had to see the commitment of the government towards spending on defense, indigenizing defense is very clear. It does not change with one budget or other budget. It is there in every policy statement. Now, I don't think in the budget they have given that how much they will spend on imports and how much they will spend on indigenous buying, right? So it's a too premature to figure out that there's no growth for defense. Fact that they've allocated more capital toward defense shows their continuous also in the defense, it's not about only allocation. You need to have ability to execute. I mean, you can't execute projects in defense in a year. There are many big programs India is going through, which are done over like 3, 4, 5, 10 years. Because if you start making, for example, a submarine, it takes many years. If you want to make a warship, it takes. So I think these programs you have to see in the context of the execution capacity needed, execution time frame needed, and money you allocate based on that approach. So I think government is very clear on that, how they want to strengthen our defense given our neighborhood, given our current geopolitical situation. So I'm not very overly worried about, and if need be, historically government has shown that they can manage resources wherever needed for a temporary requirement. We have seen that this government has been fiscally responsible, but at the same time has not shied away from ability to arrange resources for a needed requirement. So I think that adaptability this government has displayed many times. So.
Okay, so you don't sound too disappointed. By the way, some of these stocks are actually bouncing back as well. Like I was pointing out, let's get some of the defense names up on the screen. There's some green, for instance, on a BEL, on a BEML, on a Paras Defense, Masdown Dog. There's HAL on our screens right now, 6% higher. So there's some stability that seems to have returned back to this pack. So so far so good. Since we're talking about stocks in green, I'm seeing what else is bouncing back. Some of the metal names, the brutal sell-off that we saw on silver, gold, and then just complete profit taking. Hindustan Zinc, for instance, is back up to about 585. I'm just going over the defense names. Nalco is seeing a bit of a recovery, 3% up on Nalco as well. So those are some of the names on the metal side of the market. Let me take up metals. Vikas, what would be your advice? I mean, I'm not sure if you managed to participate because in the last 2-3 months, I mean, this entire space completely went through the roof. But and this is when it becomes difficult to distinguish between just pure speculative momentum and the fundamental reasons to be owning these stocks in the portfolio. How do you view it and how are you positioned on it?
I mean, before I get to metals, my only request to you is that, don't judge the quality of the budget, based on 1 day or 2 day intraday movement of the stocks, because markets can get it wrong and budgets are very different objective and in the context of a country and a government. So I would never kind of just based on a particular movement of the intraday movement of the stock prices. Now, coming to the metals, I think, of course, given the global context today, there's a huge amount of uncertainties there. There is, rearmament of every country is happening. Europe has announced big sort of capital allocation for the defense build out. So I think we will see, and in that metals, of course, and everywhere there's an investment cycle which seems to be kind of on the agenda. And the rush is happening towards the physical assets or hard asset. So combination of these two has led to we saw a significant rally in the metals. Now, obviously, whenever the sharp rally happens, you will see corrections. That's a part for the course. We've seen that environment. So now, how long this lasts, I don't know. Probably still till the time this global uncertainty remains, it will remain, which is at least 3 to 4 years, 5 years. But I don't. I mean, so we don't play metals as much as rest of the play. We understand. We don't understand the capital commodity cycle as well because there are so many global factors. So you might play that as a tactical trade, but we will never look at it as an investment trade because it requires a lot of deeper understanding of the global cycles.
Okay, all right, fair enough. And viewers, please take note of that. If someone is seasoned and who's someone who's been in the capital market for decades is calling out saying, you're not looking at this space, this is something that's kind of, requires too much of understanding. There are people, Vikas, you're saying that, and yet there are retail investors who are very quick to jump ship just because silver is up, and we get queries saying let's buy Hindustan Zinc, or should we be in Vedanta and all of that. So I think there's a strong message out there in sticking to what you understand, what you know, and building wealth based on that. So speaking about the areas that of course you know too well, Vikas, I want to now talk about manufacturing and capex, and let's break this down. There was a big number that was announced, over 12 lakh crores allocated towards capex. But what does it mean for the listed universe of stocks and entities, and what was your thought on it?
Directionally, it is positive. Directionally, it is positive. Government has done a lot of initiative towards boosting manufacturing, which it has been doing for past many years, and this is one more reinforcement of the fact, specifically in the textiles, biopharma industry, EMS, semiconductor, which are core area of focus for India government right now. Also, given the current FTAs with the EU and all, where labor-intensive sectors are getting zero duty, encouraging sort of investment back home is going to help as well that export picks up. So I think government has kind of done a good job in terms of boosting, and manufacturing is a very, very much required boost over not this year, but over next many years, and maybe more than a decade, because we have so much wanting on that. Our manufacturing GDP, which is around 15-16%, can go as high as 20-25%. And for that, you will require a lot of investment, a lot of reforms. So I think it's part of that whole process, and manufacturing don't get built overnight. It takes many decades. So I'm quite happy on that. But coming back to stocks, you have to, these kind of statements don't really add any value to a particular company. They are all sectoral reforms, and then the life goes back to finding individual stock, company profits, growth, valuations. So I think, the way we see that these are all directional things. Just because they've announced something in textile, tomorrow textile companies are not growing. Impact of these things will happen maybe 6, 9, 12 months later. So you have to see all those things in the context and start sort of planning, and that's what we do all the time.
Okay. So that's on the capex side. Anything else, that stood out for you from an investment and stock perspective? And I'm coming to the data center announcement. Obviously, it was one of the mega announcements, right? Tax holiday up till 2047 to any global MNC that wants to come and use Indian data centers. But again, Vikas, the thing is that it's difficult to identify right now very clear-cut plays in the market. If you can give us some clues and hints in terms of how you are gearing up your portfolio for some of these opportunities that were called out in the budget, whether it's AI, data centers, and the like.
See, look, we will not make any changes based on the budget because it's continuation more or less same. But some of the buckets which of course comes about, and then you will evaluate any new opportunity in light of that. For the first time, government has spoken very aggressively about services, medical tourism. How do we get, part of the global services industry pie? That government has first time spoken. I think within that, some interesting opportunities should come about. Of course, data center, again, directionally, government is very clear that we need to be data center hub because our own data is very high. And then, we can actually be home to or hub to the global data routing here by the global companies. And I think this tax deduction is in light of that or in direction of that. And I'm sure this will also create an industry over a period of time. So anything associated with the data center, one should look at with a renewed optimism. But of course, like I said, that avoid fads and you go back to fundamental, understand individual company there. In the name of data center, a lot of froth also happens, a lot of positioning happens. So one has to be very careful. I go back again. Big trends does not mean that you will get the company right. But yeah, these are some of the 2-3 segments which came about very well, and I'm sure like healthcare could be a very good, interesting opportunity if combined with medical tourism and domestic spending. It could be a very interesting opportunity from a next 10-year perspective. We are anyway very well exposed to that segment, but we think that it is only accelerating that.
Vikas, how can we end the conversation without talking about STT, the biggest debate of budget 2026, right? And by the way, those stocks are still lower. I must tell our viewers, like I said, many of them, even now, yeah, I think Billion Brains grows down 4.5%. Angel is also down about 0.25%. So now for the entire capital market space, Vikas, and for brokers, I mean, this STT hike, does it get digested and eventually we all learn to live with taxes, right? We've seen enough tax hikes on the capital market space in the last, 10, 15 years. But intrinsically, is the model getting challenged now? You either have some SEBI issues coming up or taxation issues, some other regulatory issues. So, what would you tell our viewers and investors out there who were till now being told that the financialization theme is a very strong theme and, perhaps stockbroking stocks are a great play on it?
So this is not, this is not really changing any direction that over financial as a theme and all, but this is definitely not something, at least I would expect to happen, not because they can't levy. See, STT was introduced in lieu of capital gains taxes. Now, capital gain taxes came, but STT remained. Now we are saying that we are increasing STT because we want to discourage the speculation in F&O. But that's like, that's very, in my opinion, inappropriate. It's like, you're promoting STT, F&O by making it available to every nook and corner easily to every retail investor without any qualifying criteria, and we are increasing the tax. It's like saying that perspective. Do something that what are the qualifying criteria for participating in F&O, minimum net worth criteria, some education criteria, and then participate in that rather than opening it for everybody. But I think the reluctance to do that and increasing tax, to my mind, doesn't gel well. So this is a very misplaced concept, in my opinion. It is avoided to be avoided. There's no reason for you have whole year for you to consider. SEBI has been talking about it for 2, 3 years. Why can't regulatory framework come into play and say, up to network we will not allow to participate in F&O. You need some bit of a certification to kind of get into F&O. Those things you don't want to do that. But increasing tax, in my opinion, that was misplaced. Having said that, I don't think it's changing the direction of the market, it's changing the financialization theme. But this is a very big disappointment, especially conceptually. I don't agree with it.
Okay. I mean, spelling it out as clearly as you see it. Pretty interesting. Amit Jeswani, by the way, has joined in. Amit, I'm coming to you on this STT debate in just a second. Now, you be ready. That's going to be the first question. Let's get that out of the way. But before that, I know Vikas has to leave us. Vikas, final word of advice for people out there. Like I said, it's been a challenging year. The market continues to struggle. Now we have these new global cues, and God alone knows if this global commodity bull run is, whether it's a blip or if it's a burst. AI, there's just too much going on. Overall, as the next couple of months roll on and we, move towards the summer of 26, what do you see ahead for the Indian equity market?
We have had difficult 25 years, but every 22 was a very difficult year. You had Ukraine war, which kind of ruined almost 6, 8 months. And then Ukraine war is still around, but market started zooming in 23 was a good year, 24 was a good year, first at least. So my whole point is that, every year, couple of years, we see this kind of market, right? Global uncertainty is fairly high. But my sense is that with a lot of, cross-border deals, if FTA is happening, with now, let's say, if India starting to import oil from Venezuela side, US should play it down, so that tariff should be around. So the way I see is that most of the worst is behind. 26 should be a better year than 2025. Turn opportunity come only when the pessimism is very high. Where the sentiment is highly pessimist, most people are worried than optimist, and that creates the base for a good portfolio. Like 2022 was a good vintage. I remember writing a note on, I think, September 2022, saying that this vintage will be very good vintage. So every, vintage plays a role in building outcome of the portfolio. I think the current vintage will be very interesting, play out over, a couple of years.
All right, Vikas, on that optimistic note that indeed the worst is behind us, we'll let you go, and hopefully this will be the first of many conversations. This is the first time I'm talking to you on Moneycontrol. It's a new format. It's a new set of investors who are joining in, and we look forward to more of your conversations, more of your appearances. Thank you so much for joining in. Okay. Well, with that, let's move on to our next guest. As I mentioned, Amit Jeswani of Stallion Capital is with us. Amit, good morning. Speaking after a while and speaking on the digital airwaves now, not the television airwaves. It's all digital India.
Good morning, Surbi. So nice to see you here. My best wishes to you.
Thank you. I can see a strong beam of Mumbai sunlight streaming through your window. You've got a nice foggy Delhi outside my studio here, I can tell you that. But for the market, what is it going to be? Sunshine or fog? What next?
See, we've seen a lot of fog for the last 16 months, and we are at the end phase of this bear market. The median stocks have corrected around 32% right now. From in the last 16 months, median stocks, the markets don't show you that, but median stocks on all stocks NSE are down around 32% right now. In 2018, Surbi had fallen around 38%. I'm speaking about median stock corrections. So we are at the end phase. Of course, the budget was a bit disappointing because the markets idly, when your rupee is at 92, FI has been selling 40,000-50,000 crores a year. We would have expected some relief for FIs, at least because we're one of the few economies who tax FIs. Of course, that has not happened, and that's been a bit of a disappointment because globally the markets like FIs have made a fortune across the world, and India is an underperformer. We were expecting some meager kind of event, a Make India Great Again kind of event, but that's unfortunately not happened in this budget.
Okay. Market, by the way, is showing some green now. I just want to point that out. Let's quickly get the hot boards back up, and then we'll resume our conversation with Amit. So you've got a 0.25% gain on the Nifty. So that green is holding. The mid-cap index is also recovering from the losses quite nicely, actually. Mid-cap index is down less than 0.2%. Bank Nifty is flat. So the market is kind of stabilized. As some was saying yesterday, our colleague here, Shweta Punj, was telling us that the view from North Block seemed to be that it's okay, the market will move on, it'll kind of get over this whole STT hangover. Maybe it's happening. That's exactly how it seems to be playing out right now. I'll just call out some of the stocks that are rising. Lodha Developers, Hindustan Copper. We should pull up some of the mid-cap gainers actually. MRPL, NetWeb, Sirma, some of the EMS stocks, because the outlay for some of these electronics manufacturers, that's been increased quite a bit. So that's a stock on the upside as well. Canfin Homes, plenty of names actually on the mid-cap screen. So latent view, it's not a bad looking mid-cap screen at all when I look at mid-caps. And even on the large cap side, like the Nifty is telling you, look at L&T. L&T is now the Nifty gainer. Those are the stocks that I was alluding to earlier, some of the key gainers. And then we've got L&T, which is up about 3%. So that's where things are, at least for the time being. Not a bad looking screen for sure. Okay, so Amit, now let's budget is one thing, but before we talk budget, I want to understand what you've been doing, because we haven't spoken for a while, and how you've changed your portfolio positioning over this last 12-month phase. Earlier, I'm just telling for the benefit of our viewers who are joining in and who are hearing Amit for the first time on Moneycontrol. Amit's style used to be to catch growth, be where growth is, but then growth started faltering, Amit. That was the problem with the market, right? Last 12 months.
So wherever growth corrects, we correct our position sizes. So if the growth changes, we change. So we are a very dynamic kind. Our strategy is a bit dynamic, where we chase growth, and wherever growth changes, we change our position sizing up or down. So basically, that's been our style of investing, where we buy typically market leaders, very high growth, gaining market share kind of companies, and we have about 25-30 companies in our portfolio. So that's how we do. And India is a growth market, to be honest. Most people come to India leaving a US or any other economy and come to India because India is a growth market. And That style's exactly the same for the last 7.5 years for us in the PMS. So nothing has changed in our style. We
Yeah.
ride our winners, we cut our losers. Yeah, the same.
Yeah.
The same game.
Same thing. It's just that finding those, those growth plays. I mean, 24 was a market where you had spaces. You had EMS, which is doing really well. You had a couple of consumer companies that were really shooting through, and at least 25-30% growth was assured. Now, where do you see those pockets? And give us some sense of the overall portfolio. I mean, just in terms of sectors, in terms of your, big winners. What are you backing now?
So winners are changing very fast, actually. So yesterday, our big winners would be stocks which were related to gold kind of plays. But of course, that has corrected. Gold is now down around 20%, 18% probably.
Yeah.
One at $4,600 against $5,600 about 2 days, 3 days ago. So we are in a volatile world, but we are not bearish on gold at all. In fact, at some point of time, we might consider buying gold in our own portfolio as well. It's a put against Donald Trump. You don't have to look at social truth again and again if you have gold in your portfolio. And right now we do need some hedges against Trump, because we have 3 more years of Trump to go. This is just 1 year. So we've just finished 25% of Trump's tenure. So we need to protect our portfolio. So trends are changing very fast. If you see what happened to PSU, see the only 3 sectors that were making new lifetime highs were gold related stocks, commodities, and PSU Surbi. And PSU banks yesterday, most of them were down between 5 to 10%. Commodities have fallen 20%. So it's been a tough thing for a trend chaser. Of course, we don't have commodities in our portfolio, but now we'll have to find newer trends. That's the whole game. First is to manage risk, and the second thing is then keep finding newer trends. So right now, I wouldn't say that there is some trend that I'm hyper bullish on. The budgets just happened about 24 hours ago, and we're just trying to digest the news which is coming. But I can tell you one thing for sure, that wherever the new growth comes, that is where we will position ourselves.
That is where Stallion would be. That's the name, right? I mean, you chose that name for a reason, I'm sure. Stallions run fast, and they run strong, and they run with growth. So, yeah. Okay, so you mentioned PSU banks, and that was the problem, Amit, in the market right now is that metals were working, and now that whole trade is getting questioned, and banks and financials were working, and yesterday we had a big question mark on that as well. But so at least let's try and answer the BFSI question mark. Are you still optimistic on PSU banks, private sector names? What about these broking stocks that we were just discussing with Vikas Khemani as well, the whole capital markets play? Just break it down. BFSI, what do you feel a little convinced on, and where do you think that there's just too much confusion, so you'd stay away?
So capital market, I don't think it's the end game. If you see, the end game would be if expiries were curtailed, number of option trading days were curtailed, and that has not happened. The government has made its decision very clear. The good part is that 5 bips of it will not kill the market. I don't see even the growth rates coming down for these kind of companies. It will not impact growth more than 4-5%. If you see the broker reports today, all broker reports are pointing towards, some are saying 3%, some are saying 6%, but broadly 5% growth rates will change. But I would say that decent money would get made in. See, capital market as a trade is not going away, and I expect volumes continue to go higher even after this 5. It's not something which is good. It shouldn't have happened, but now that it happened, it's not going to change the trajectory so much, because it still remains a high growth sector. It still remains, like, if you look at the volumes which are getting traded, it's insane what is happening in markets, and that is one trend that we are still. This dip might be an opportunity. It's not game over.
Okay, it's not the end of the world for capital marketplace. Got that. And banks?
Yeah.
What are you keeping in the portfolio right now?
Private banks have anyways not given any money. Like like the top banks like HDFC, Kotak, etc. No one's been able to make money there. ICICI, etc. No, me, my clients, Stalin Asset, we're PMS. My clients have positions across stocks. But that is not where money's got made. Money's got made in PSU banks, and they look normal. They'll be now market perform. They will not be like outlier outperformers. Anyways, the results were not so good. If you look at numbers for the PSU banks that came out, they were not rocking. There was a trade that the game that happened, Surbi, here was that PSU banks started growing faster than private sector banks. If you look at an SBI, it grows faster than ICICI Bank. It grows faster than HDFC Bank. If you look at Bank of Maharashtra kind of place, they were growing like 2 times faster than HDFC. So the growth rate, who would have thought 3 years ago that PSU banks will grow faster than private sector banks? And that is exactly what happened. But right now, from this stage on, I would say they'll be at best case market perform.
Market perform. Okay. Amit, final advice for people navigating what has been, like you're saying, a really difficult market. Your final golden last words.
So 16 months of bear markets is a long time for bear markets. Typically, bear markets last for 18 months. I think we're at the end stage. Median stock corrections are 30%. Number of oversold stocks less than 30 RSI are at 2018 levels. I would say from these times, it is there is a lot of news. There's a lot of reason to be bearish, but sentimentally we are near the bottom, and price-wise also we are near the bottom. That I'm speaking unless this is a 2008 kind of event or a nuclear war or things which we can't know, of course. But sentimentally, this is not the time to be bearish on the markets. This is the time to, while it's tough to be bullish, but it will pay to be bullish.
Okay, that's a nice line to end with. It's tough to be bullish, but it'll pay to be bullish. I'm sure our viewers have taken note of that. Great conversation as always, Amit. Good luck to you for the rest of 2026. And we will definitely be catching up more often. And I'm looking forward to those conversations as well. You have a great day.
Thank you.
Thank you. Bye-bye. Okay, so those are two big market views coming in. And the market has kind of found its footing, at least for now. The pain and the sort of the disappointment of yesterday, well, that seems to be a thing of yesterday. Market stabilized. Nifty is holding on to a gain of about 5%. Now, yesterday's shock and pain really stemmed from all things tax, as is usually the case when it comes to the union budget. So now it's time to dive a little deeper and understand some of the nitty-gritties that were announced. STT, of course, was the headline. A couple of other important tax changes as well. And to take us through that fine print, we have with us Sameer Gupta of EY. Sameer, good morning and great to have you back.
Quite a busy day yesterday. And, as we've seen in tax, while the speech is short, the bill comes with a lot of fine print in it, correct?
Yeah.
So that's what kept us up till pretty late at night. And quite a few announcements have been made. Like you rightly said, the STT piece, market were able to pick it up very quickly in terms of the whole F&O space. It's a continuation of a series of things you've seen, after the whole retail investor story that played out a couple of months back, right?
Yeah, absolutely.
So I think, yeah, go ahead.
Yeah, no, so Sameer, I actually wanted to start right there so that we get it out of the way, and then we have to go to a lot of the other announcements. Now, on STT, on futures and options, I mean, we know the increase. And the increase on STT has been happening for a while. I think it was the budget before last, I think it was 23 or 24, where the rates were changed again. So typically, I'm not sure if there's enough evidence that tells us that you raise tax and the amount of trading actually goes down. But, just give us your deeper insights on this, on the way, trading is being taxed here vis-a-vis elsewhere. And the big argument that a lot of market people made since yesterday, including Vikas Khemani just now, he was with us before you joined, saying that, there could have been a carve-out, there could have been another way. Increasing tax, I mean, does that really curb speculation at a time when capital gains is still very much in existence? So that's dual taxation on those who are buying and selling shares in the market.
No, I think, look, for sure, we've discussed this earlier. This is like a dual levy. We are in a unique market where you have both capital gains tax as well as STT. And I think that, shows in trading costs, it shows in compression of margins. And I don't think that, therefore, long term, that's a great situation to be in. So some relook at STT will definitely happen in the future. I just think that a lot of what we are seeing is probably driven more by market dynamics right now. And we don't have the evidential data to suggest that, STT on derivatives will be so much. And therefore, by doing this, is it a revenue measure or is it a policy nudge to tell retail investors to stay away? I don't think there is credible data because all of the data on STT comes as one conjoint number, which is the 80,000 crore budget that they had. So as yet we don't have that, Surbhi, to answer that with empirical data as to whether this is something that will really be a revenue mobilizer or whether this will actually be something that will curtail activity. And as we know, market that as other things pick up, the market does tend to move on. So hopefully that's what will also happen over here. And like you're rightly showing on the slides, definitely the rates have been increased. They were launched, 10 years odd back, and then in 24 they almost doubled it, and now again they have done that. So hopefully this is the end of the road, at least on F&O STTs. I think that's the way I would put it in terms of where we are headed.
Okay. That's STT. Let's also talk about the change once again in buyback taxation. That's the other market bit. I think by the end of the speech, it had become kind of clear that okay, it's not negative. It's actually pretty decent. But just run through, because buyback taxation keeps getting changed every now and then. First it was dividends being taxed differently in buybacks, and then people were saying there's an arbitrage between dividends and buybacks, and they said, okay, buybacks will be taxed in the hands of the shareholder. And now we have another change, which was announced yesterday. So just, simplify it for us, please.
Look, the start was capital gains used to be the norm. So that is the classical way in which buyback has always been understood. So in that sense, we are back to that. So it was always capital gains. Then it got changed into, incidents moving from the shareholder to the company when we had a buyback tax being paid by the company. And now, as of today, before the law will change, it is being treated as dividend income. And now we are back to capital gains. So you're absolutely right. We've seen this sort of, flip-flop over the last 20 odd years. I just think that capital gains is the classical way for buybacks to be treated. So that I think is clear. So in that sense, we are back to where we should have always been. So that's the first point. Second, of course, is that somewhere in, the scheme of things, what the government has laid out is that the shareholders, depending upon, the status of the shareholders, you will be paying capital gains tax at the level of the shareholder. So firstly, because it is capital gains, based on the buyback price, you will get a full deduction for the cost. And then on the gain, you will pay the tax. In the dividend scheme that is there today, as you know, the entire amount that you were receiving as buyback proceeds in the hand of the shareholder was being entirely treated as dividend, that were being taxed at gross basis without any cost deduction. And the cost was going to be taken separately as a capital loss. So for example, if you were the only thing you had was buyback proceeds in that year, then you were paying tax entirely on dividends, and the capital loss that is artificially generated on your holding, if you had no other capital gain, then that was like a double whammy. So I think to that extent, this kind of streamlines the taxation provisions, and you are back to what it should have always been, which is that buyback proceeds is equal to the as if they're like sale proceeds minus the cost, and the capital gains is what you will pay tax on. So I think to that extent, it is a huge positive. The only thing that they have done, as we've seen, is that they also have put in a provision, and this is more to deal or counter anti-avoidance, where they have said that if there is a promoter who is participating in the buyback, then that promoter will be looked at in an unlisted company as defined under the Companies Act, if it is a listed company as per the SEBI norms, and that promoter will not get the long-term capital gains tax rate, which is, let's say 14.95, 12.5 plus surcharge and education cess. But that shareholder promoter will actually have to be paying additional tax, in the sense that if their regular tax liability is at 22% for corporates and 30% for individuals or non-corporates, then they will have to actually cough up that tax rate on the capital gains. So effectively, they have done two things. Retail investors and everybody who's not a promoter will get taxed as capital gains, simple.
Which is 12.5%. So Sameer,
which is 12.5%.
Yeah, I'm just reiterating the rate so that it's very, very clear. Once the budget is passed by Parliament, and once it becomes the act, then from FY27, retail investors, if they're participating in a buyback, they will have to pay capital gains on those buyback proceeds at the rate of 12.5%. That part is clear.
That is very clear. Yes.
So now the other categories, what happens to promoters? Yeah.
Yeah. So to promoters, the underlying thinking is that, they may be involved in ensuring the money comes to them as buyback as against dividends. So in their case, the tax rate of 12.5% moves to 22% if you are a company which is receiving the buyback proceeds. So companies are taxed at 22%, which is their corporate tax rate, right? For business income, for example. So that goes all the way to 22. And in the case of non-companies, that rate will go to 30%, which is, the highest maximum marginal rate. So you are going to have to cough up that additional amount of tax and pay that on the buyback proceeds that you have. So that part, from a promoter point of view is not great to have.
So basically, promoters will continue to pay tax on buyback proceeds as per either the prevailing corporate tax rate or the individual rate, the maximum rate, which is 30%.
That's right.
So essentially, for them, they don't get the advantage of treating this as long-term capital gains.
Yeah, so the promoter category will not get this benefit of buyback rate, which is 12.5% that we spoke about, right?
Got it.
So,
Got it.
So to that extent, so this is where we are on the whole, buyback scheme of things.
Okay, all right, got that. Some of the other announcements, and Samir, you were telling me this, before we spoke, just before the budget, on safe harbor, and how that becomes a big, a big issue for the IT sector. A couple of announcements were made. Just take us through them, and whether all the asks of the tax world in the industry, whether they've been met.
Absolutely, Surbi. I think other than the capital markets provision that we spoke about, I think the focus of the budget, at least the way I saw it, was that they are going for strategic long-term impact sectors. So whether it is nuclear power, data centers, and of course GCCs. So coming to GCCs, right? As we know, the GCCs are operating in India where they are captive GCCs of their global organizations. So the transaction is one which is of a related party because they are 100% owned by their foreign parent, and therefore they have to be subject to transfer pricing. These GCCs, under the earlier safe harbor, the current safe harbor regime, once it amends, then we will see what it is. But the current safe harbor regime, the rate is between 18 and 24, depending on what you do. If you're doing lower end work, it's 18. If you do KPO, then it goes to the higher end of 24. And if you're doing contract R&D, then it's somewhere in between. So you have safe harbor, which is being spelled out for different categories at different rates. Now, two things. These rates globally are quite high if you look at the global benchmark. So that was one cause of concern. And the other was, companies would always also get into friction on whether I'm doing BPO or whether I'm doing KPO, right? Because the rates matter in that. So there was friction on how you were labeling yourself, and the tax office, and the taxpayer would get into disputes on these areas. What they have now done, Madam Minister has, basically said that, look, there is friction. I'm going to do away with everything. We will collapse all these different categories. And call everything
KPO, BPO, and all of that. All of this now becomes IT services. So no matter whether you're running a
basket. Yes.
Okay, so if you're a GCC, now whether you're doing R&D work or BPO work or whatever, basically it's all under IT services, and that's how the safe harbor rules will apply.
Correct. So that is now one big bucket, which is IT services. And the rate she has given is 15.5, which is quite competitive actually, right? So this is how she's looked to deal with the entire safe harbor regime. Second, safe harbor regime could only be accessed by Indian captives whose turnover was 300 crores. All right. So that kept it, only to very small or, mid-sized kind of companies. Now she has said that if your turnover is as high as 2000 crores, right, you could access this regime and therefore benefit from it. So we don't yet know out of the total captives how many will actually fall into this, but I would guess that a significant number of captives would be able to position themselves into this basket now. And what we have to still wait now, this is all in the speech, all right? We do need to wait for the more detailed circulars and guidelines to come out, whether there are any conditionalities subject to which this will apply. There could still be some questions that will apply in terms of the nature of the work. IT services, while she is very clear, we still need to look at that definition, how it will come together. So yes, so GCCs was a big focus area, given the contribution it has to the GDP.
GCCs absolutely, get the benefit of easier safe harbor rules and a lower rate of tax, less stringent criteria. So very simple. You come in, you meet those thresholds, and then now you have to pay just around 15% tax. So that's very clear. Samir,
Yes.
two quick last points, and I want you to now tell us this whole data center announcement. Sounds fantastic,
Yes.
tax holiday all the way up to 2047. And basically, this is like India telling, big global giants saying, look, come, use our data centers. We're going to give you a tax holiday. So it sounds great like a headline, but there's a fine print because there are certain conditionalities, I think, involved. What did you think of this this tax holiday? I mean, will it
So-
really get the people here to use our data centers?
Yeah, so I think that this was again quite bold and much needed, right? Let me break it up into three parts. So the way the whole cloud services industry will work is that you will have the cloud service providers who will be, in this context, a foreign company providing cloud services to their global clients which are outside India. So they are providing them cloud services, data services, and those contracts are commercial contracts which are negotiated and are large value contracts. Now that this foreign company typically will set up an Indian company, which will again be its subsidiary. And the Indian company will build out the entire, cloud infrastructure stack, right? So the Indian company will undertake that investment and will, carry out the build out of the stack over here. When the Indian company renders services, it will render its services typically to the foreign company, which in turn will then provide, a layer of services and render the cloud services to the client. So what they're saying is three things. What they're saying is that the Indian company and the transaction it has of providing services to the foreign parent, that will still be taxable in India. And that is your typical cost plus, kind of a transaction. And that is one where the Indian company will say that, okay, if you would like to go for a safe harbor, and they have in this case given 15, not 15 and a half, then they could opt for that. If they want something lower, then obviously they have to go and negotiate through an APA. So that part is clear in terms of how the Indian company will deal with the foreign parent. So that is still going to be taxable. What the foreign company is earning from the clients that they have, there they have made it clear that India will not look to bring any more tax in on that transaction, and that foreign company will not have to worry about any further taxation once they have paid the Indian subsidiary. And that is the tax holiday that we are talking about. And that tax holiday will go all the way till 2047. So essentially, it is protecting the foreign companies' commercial contract and the revenue they make from their overseas clients from Indian taxation. So what this is the sum and substance, Surbi, of the whole data center provision.
Okay, so basically their international revenue, just because they're using an Indian data center, their
Yes.
international revenue remains, outside the
Protected.
remit of, for Indian tax authorities. So that makes sense. That
Yes.
just because you're using an Indian service provider in an India data center, they
Correct.
don't have to worry about tax on their global revenue. That's how it's going to play out. Samir, final
Yes.
thoughts? I mean, anything else that really stood out for you? And there was some mentioning in MAT as well. I'm not sure how significant that is. So just a view on that, the minimum alternate tax.
Yeah, so I think that is like a nudge to everybody who's in the MAT regime, right? To move to the concessional tax regime. The way the MAT regime works is that you are able to carry your MAT credits and claim them if you continue to be in the old regime, which is the 30% tax rate regime, right? The 22% corporate tax regime, which we have been speaking about for a while now, in that, I mean, companies have not moved to that regime because many of them, especially if you were SEZs, had large MAT credits which they were still absorbing. So in a way, they are, giving them a nudge to say that, okay, why don't you streamline, simplify, and carry 1/4 of that credit into the new concessional regime of 22%. And if you do that, then of course, things will align from a simplicity point of view. So I do see that companies will have to look at their MAT credit values and evaluate. If they are in the early stage of claiming MAT credits in the 30% regime, then maybe they will just switch. If they have huge accumulated balances, then that can still take time. So it's going to be a mixed bag as far as the MAT credit part is concerned, will be.
Yeah, it reminds me of what we were doing last year, Samir. All of us personal income taxpayers. We were calculating standard deduction and what is right. Health insurance premium, all of that, housing, home loan, adding up all of the deductions and seeing whether you are better off in the old regime or the newer regime. So corporates have to do that as well, and they've been incentivized to move to the new regime in terms of corporate income tax. Got that, Samir? Final thoughts from a tax policy perspective. How do you rate and rank the budget? Given a lot of the expectations that you went in with, how many more met?
No, I mean, I won't score it, but I would just say that, look, I think they've been quite tactful in, putting their bets on the long-term growth sectors. So to that extent, I think it was, seeing a lot of the provisions with a lot of, from a fresh perspective. I think that's the part which I think was really good to have. And the other thing I would just say is that also on the procedural side, there are a whole lot of things which they have also set out, which obviously we didn't go into, rightly so. But there is a lot of matter in that detailing. The last thing only I would say is, Surbhi, that, tax certainty and tax clarity. I think the budget does try to hit those, with the data center concept, the safe harbor regime, so definitely they are looking at all of those kinds of, signals to give the investor community very positive vibes. The only thing that was probably, something could have been said or done with was on the back of the whole, ruling, the Tiger Global ruling. If there was some statement there to, just assuage some concerns, that we won't reopen past cases, then of course, that would have been a very welcome step.
Oh, well, we will wait on another few months. We'll have another budget. And of course, we'll see if some of these other residual issues get taken up. But I think overall, quite all right. And the market also, as we're winding up this conversation, the market seems to have digested this STT hike. I mean, we've seen it before. We've seen this picture before. And then you learn to live with it and learn to move on. That's what seems to be happening. Samir, thank you very much for joining in. Great conversation as always. Very helpful, demystifying and simplifying all of those tax announcements. You have a great day. And of course, we'll keep interacting during the course of the coming months as well. Okay, so back to the screen as we're winding down. It's absolutely flat. It's quiet. The good thing is that the lows of the day, the lows of the morning are being bought. The Nifty Bank is also now trying to come back to the flat line. The Nifties are already flat. The mid-cap index is also flattened out. Just quickly checking in terms of the themes, sectors, the gainers and losers. I'm just going to check out what the big movers are. So if we talk about the gainers of the day, the capital market side of the market, that's where the recovery is. The capital market index is up about 1% right now. Infra, realty, metals, overall recovery coming through. And those are some of the top Nifty stocks which are flashing some green as well. Big heavyweights like L&T and Reliance looking positive at this juncture. That's where we wind down this edition of Opening Bell. Many thanks for watching. We'll keep getting you more updates on the market over the next couple of hours.